This video is going to discuss the direct write-off method of dealing with bad debt. The accounts receivable balance in the general ledger reflects all amounts owed to the company by customers. However, some customers will never pay their account. These uncollectible amounts are referred to as bad debts. Companies must deal with these bad debts, and there are two methods of accounting for them, and that is either through the direct write-off method or the allowance method. In the direct write-off method, a company writes off bad debt and records that bad debt as an expense at the time the receivable is determined to be uncollectible. So if on August 4th, ABC Company determines it cannot collect $350 from Martin, a credit customer. Currently, there is $350 of accounts receivable recorded in the accounts receivable account for this customer. The company has determined Martin won't pay. So the $350 is decreased out of accounts receivable and the bad debt expense is recorded. When a little bit later, Martin decides to pay the $200 of amounts previously written off, the company would first reverse the write-off entry by putting $200 back into accounts receivable and decreasing the bad debt expense recorded, and then record the cash payment from the customer by debiting accounts. Then they would record the cash received from the customer by debiting cash and crediting accounts receivable. This method of dealing with bad debts is not allowed under generally accepted accounting principles, primarily because of the matching principle or the expense recognition principle, which requires expenses to be reported in the same accounting period as the sales they helped produce. The direct write-off method does not meet this principle because if a customer sale on credit is made in 2019, but the write-off is not made until 2020, the revenue from the sale is recorded in 2019, but the bad debt expense of that sale is recorded in the following accounting period. The revenue and expense are not matched in the same period. The other reason generally accepted accounting principles do not allow the use of the direct write-off method is the materiality constraint. The materiality constraint states that an amount can be ignored if its effect on financial statements is unimportant to users' business decisions. However, because bad debts are typically pretty significant, they cannot be ignored, and so we cannot ignore the bad debts. They have to be recorded and dealt with.